Welcome to Audio Mentors, your space where financial education comes to life through our summaries and audiobooks. On this occasion, we present a complete financial education manual, key to understanding how to manage personal finances, make informed decisions about savings, credit, investment, and creating a solid budget. This summary has been made exclusively by us, with the aim of offering you the essential tools and knowledge to improve your financial health. Throughout each chapter, we will explore key concepts such as types of financing, how to avoid over-indebtedness, and how to plan for the future without losing control of your current finances. If you are interested in continuing to learn about finance, don't forget to subscribe to our Audio Mentors channel. By doing so, you'll be able to access more summaries, audiobooks, and in-depth reflections that will help you take control of your finances and move towards a life of economic stability and financial freedom. Let's begin this journey towards financial knowledge and personal success. Chapter 1. Introduction to Financial Education. In this first chapter of the Financial Education Handbook, we address the critical importance of understanding and managing personal finances efficiently. Financial education is a set of principles, knowledge, and skills that enable us to make informed and responsible decisions about money management, investment, saving, and the use of credit. This knowledge has become more essential than ever in a world where financial decisions profoundly affect our daily lives, from the acquisition of goods to planning for the future. The importance of managing personal finances. Proper management of personal finances is not just about paying bills on time or avoiding excessive spending, but about making smart decisions that allow us to live within our means, avoid financial stress, and build long-term wealth. Living without a clear financial plan can lead to serious problems, such as over-indebtedness, lack of savings, and a constant feeling of economic insecurity. This not only affects our financial stability, but also our mental health and emotional well-being. The need for financial education in today's society. In modern society, financial education is more than a tool. It is a basic necessity for survival in a complex and constantly changing economic world. Increasingly, people are faced with a variety of financial products ranging from mortgages, personal loans, and credit cards to investments in financial markets. Without a proper understanding of how these products work and the implications of using them, people can easily fall into unsustainable debt, make bad investment decisions, or simply fail to take advantage of opportunities to improve their financial situation. A common problem is the lack of basic financial education that many individuals face. Schools often do not provide adequate training in this area, and many people have to learn on their own or make costly mistakes to acquire essential knowledge. However, the good news is that it is never too late to learn. Financial education can and should begin at any stage of life. Impact of financial education on economic stability. The impact of financial education on economic stability cannot be underestimated. People who understand the basic principles of how to manage money are more likely to lead a balanced financial life, make informed decisions, and avoid serious financial problems. Financial education also opens doors to financial independence, one of the most important goals for many people. By learning to save, invest wisely, and use credit responsibly, one can build a more secure and stable future. Saving and investing are key areas where financial education has a direct impact. People who understand the importance of saving, even if it is only small amounts, can create a financial cushion that allows them to face emergencies, pay off debts, or invest for the future. Knowledge about how to diversify investments is also fundamental, as it allows money to work for the person, instead of just waiting for compensation for its work. Creating healthy financial habits. The purpose of financial education is to teach people how to manage their money in a way that allows them to achieve their financial goals and live within their means. One of the most important concepts to understand is the habit of living below one's means. This does not mean living austerely or deprived of luxuries, but having enough control not to spend more than one earns. Creating a budget is an essential step in living within our means, as it helps us visualize how our income is distributed and make more responsible spending decisions. In addition, financial education encourages the development of other positive habits, such as financial organization, debt monitoring, and setting clear short-, medium, and long-term goals. These habits can make the difference between a life full of financial worries and a more balanced life, where money is used as a tool to improve quality of life and not as a constant source of stress. The concept of debt and credit management. Another key aspect of financial education is understanding the concept of debt. Many people don't know the difference between good and bad debt, or how to use credit effectively. Debt can be a useful tool if managed properly, such as when taking out a loan for education or a mortgage to buy a house. However, when credit is used irresponsibly, such as excessive use of credit cards or accumulating unnecessary personal loans, it can quickly become a financial trap. Financial education teaches us how to avoid falling into the cycle of over-indebtedness and how to prioritize the repayment of high-interest debts. An essential aspect of debt management is the refinancing or restructuring of payments, tools that allow the debtor to reduce their monthly payments and better organize their finances. Savings and investment. The path to financial independence. Financial independence is one of the most coveted goals, and financial education is the path to achieving it. By understanding the concepts of saving and investing, people can begin to build a more solid financial future. The difference between saving and investing is fundamental. Saving is putting money aside for a specific purpose or an emergency, while investing involves putting that money to work in financial instruments such as stocks, bonds, mutual funds, real estate, among others. Financial education teaches people to diversify their investments, manage risk, and make intelligent decisions based on an analysis of their economic situation. Learning to invest is one of the best ways to ensure constant growth of resources and the creation of wealth in the long term. Impact of financial decisions on general well-being. The relationship between our financial decisions and our general well-being is profound. Personal finances are not just about numbers and accounts. They affect our quality of life, our relationships, and our mental health. Debt-related stress and a lack of savings for emergencies can have a negative impact on people's emotional and physical health. A key aspect of financial education is teaching us to make decisions that not only improve our finances, but also our well-being. Having control over our finances, knowing that we have a savings plan and an emergency fund, reduces stress and allows us to live with more confidence and peace of mind. The future of financial education. The world of finance is constantly evolving. With advances in technology and access to information, the financial landscape is changing rapidly. New tools, such as personal finance management mobile apps, the use of cryptocurrencies, and online investments, offer new opportunities, but also bring with them new challenges. Financial education must adapt to incorporate these new technologies and ensure that everyone has access to the information needed to make informed decisions. Chapter Conclusion. This first chapter has underlined the crucial importance of financial education in everyday life. Proper management of personal finances is not only vital for our economic stability, but also for our mental health and general well-being. Throughout this manual, we will explore the fundamental concepts of how to make money work for you, how to avoid falling into the traps of indebtedness, and how to achieve financial independence. Financial literacy is not just a skill, it is a powerful tool that can transform our lives for the better. In the next chapter, The Family Budget, the foundation of a sound economy, we will explore how to create an effective family budget that helps manage income and expenses, ensuring long-term financial stability. Chapter 2. The Family Budget, the foundation of a sound economy. In this chapter, we delve into one of the most important aspects of financial management, creating and managing an effective family budget. A well-crafted budget is the fundamental tool for maintaining control of personal finances, ensuring that income and expenses are managed efficiently to achieve short, medium, and long-term financial goals. What is a family budget, and why is it important? A family budget is a financial plan that helps families allocate their income among different expenses, savings, and investments. This plan not only helps families be clear about how their money is distributed, but also provides a clear guide to avoid waste and ensure that resources are being used effectively. Having a budget allows you to identify areas where you can cut expenses and, most importantly, helps you live within your means. A budget is essential to prevent financial problems such as over-indebtedness and lack of savings. Without a clear plan, It is easy to spend more than you earn, which can result in growing debts and a lack of money for emergencies or long-term projects. Having a budget not only provides control over finances, but also gives a sense of security and economic stability. Steps to create an effective family budget. 1. Determine monthly income. The first step in creating a budget is to know how much money you have available. This includes not only your monthly salary, but also any other sources of income that may form part of the family budget, such as extra income, investments, or grants. 2. Record all expenses. It is essential to keep a detailed record of all expenses, from the largest, such as mortgage or rent payments, to the smallest, such as grocery shopping or subscriptions. Expenses can be divided into two main categories. Fixed expenses. These are expenses that do not change from month to month, such as rent, mortgage, utilities, insurance, and debt payments. Variable expenses. These are expenses that can fluctuate, such as food, transportation, entertainment, education, and miscellaneous purchases. To get a complete picture of family expenses, it is important not to omit any details, no matter how insignificant they may seem. 3. Classify and organize expenses. Once expenses have been recorded, it is useful to organize them into categories to better understand what the money is spent on. The categories can be customized according to the needs of each family, but generally include food, transportation, entertainment, health, savings, and debt repayment. Proper classification will help you see which areas are consuming more resources than expected and where you can cut back. 4. Set savings and investment goals. Having clear objectives is a crucial step in drawing up a budget. This includes setting savings goals for emergencies, retirement, or specific projects, such as buying a house or a car. Experts recommend allocating at least 10% of monthly income to savings. It is also important to consider investments, as investing wisely can contribute to the growth of family wealth. Investing in funds, stocks, or real estate are options that can generate long-term returns. 5. Adjust expenses to balance the budget. After being clear about how much is earned and how much is spent, the next step is to make adjustments. If expenses exceed income, it is crucial to identify areas where cuts can be made. This may involve cutting back on entertainment expenses, switching to cheaper insurance, or finding cheaper alternatives for certain services. The goal is to balance income with expenses, ensuring that one does not live beyond one's means. 6. Review and adjust the budget regularly. A budget is not something that is set once and then forgotten about. It is important to review it regularly, at least once a month, to see if the savings targets are being met, if there have been any changes in income, or if adjustments are needed due to new circumstances. As you progress through life, your priorities and needs may change, so it is essential that your budget is adjusted accordingly. Benefits of having an effective family budget. Full control over money. A budget allows you to know exactly how much money comes in and goes out each month, helping you avoid unpleasant surprises at the end of the month. Debt reduction. By identifying and prioritizing expenses, a budget can help you pay off debts more quickly and avoid new accumulations of debt. Encouraging saving. Having a budget forces you to set aside part of your income for saving, which is crucial for creating an emergency fund or financing long-term projects, such as education or retirement. Preparation for the future. A budget not only helps you manage the present, but also allows you to plan for the future. With a well-organized budget, you can set clear and achievable financial goals and have a structured path to achieve them. Avoiding financial stress. Knowing that you are in control of your money and that you have a plan to meet your needs and goals can significantly reduce stress related to finances. Common mistakes when creating a budget. Failure to include all expenses. People often forget to record small daily expenses, such as morning coffee or impulse purchases, which can throw the budget out of whack. 2. Lack of flexibility. Budgets that are too strict can be difficult to follow. It is important that the budget has enough flexibility to adapt to unforeseen situations or changes in income. 3. Failure to prioritize saving. Some people leave saving until last, when in fact saving should be one of the first priorities, regardless of expenses. 4. Not reviewing the budget regularly. Setting a budget and not reviewing it for months or years can cause it to lose focus and become out of sync. It is necessary to evaluate and adjust the budget regularly. Conclusion: a family budget is not only a tool for managing money, but also a powerful strategy for achieving financial stability, reducing debt, and creating a more solid financial future. The key to a successful budget lies in discipline, organization, and flexibility. With a well-designed budget, families can confidently face any financial challenge, achieve their goals, and live within their means. Remember that financial education is an ongoing process that requires review, adjustment, and commitment over time. In the next chapter, The Need for Financing, we will explore when and why it is necessary to resort to outside sources of financing and how to make informed decisions in this regard. Chapter 3: The Need for Financing. In this chapter, we will explore the concept of financing and analyze when it is necessary to resort to external sources of money. Although proper management of personal finances can often allow us to live within our means, in some cases, external financing becomes an indispensable tool for achieving major goals, such as buying a home, financing studies, or growing a business. Understanding when and why to resort to financing is an essential step in making informed financial decisions and avoiding falling into the trap of unnecessary debt. What is financing and why is it necessary? Financing refers to the act of borrowing money from an external entity, such as a bank, a financial institution, or even friends and family, in order to finance a purchase or investment. When we do not have enough money available to cover a significant expense or an important project, financing is presented as a solution to access the necessary resources. However, resorting to financing should not be taken lightly. It is important to understand the associated costs and one's ability to pay before committing to a loan or credit. The aim of this chapter is to provide you with the tools and knowledge to determine when it is appropriate to resort to financing and when it is better to avoid it. When is it necessary to resort to financing? There are several situations in which resorting to external sources of money can be useful or even necessary. Below, we explore the most common cases. 1. Buying a house or property. Buying a house or property is one of the biggest expenses most people will face in their lifetime. Since most people do not have enough capital to pay for a property in full at once, taking out a mortgage is a common way to obtain the necessary financing. By doing so, the cost of the property can be spread over many years, making it easier to acquire a home without having to raise all the money immediately. 2. Financing education. The cost of education, especially university or postgraduate education, has increased significantly in many countries. Many people take out student loans to finance their studies, which allows them to access a quality education that can improve their future employment prospects. While student loans can be a temporary burden, investing in education can pay off in the long term in the form of higher-paying jobs and greater career opportunities. 3. Starting or expanding a business. Entrepreneurship and business expansion often require initial investments to acquire resources, products, services, technology, and working capital. While some entrepreneurs can start their business with their own savings, in many cases it is necessary to resort to loans or external investors to finance the project. Obtaining financing for a business can allow it to grow faster, attract customers, and maximize its chances of success. 4. Emergencies and unforeseen expenses. Life is full of surprises and emergencies. Whether it's a medical emergency, a major home repair, or an urgent need for money, having access to sources of funding can be crucial. Lines of credit, personal loans, or quick credits can be useful solutions in emergency situations, as long as they are used responsibly and the associated costs are taken into account. 5. Improving the quality of life or acquiring important goods. Sometimes, people may resort to financing to acquire products or goods that improve their quality of life, such as a car, household appliances, or even vacations. However, it is important to assess whether the expense is really necessary and whether it can be financed responsibly. Types of financing available. There are different types of financing available, each with different characteristics. Knowing the differences between these types of financing is essential to choosing the most appropriate one according to our needs and our ability to pay. 1. Personal loans. Personal loans are a common form of financing for large expenses or emergencies. They are characterized by being short or medium-term loans, which are repaid with previously established interest. Depending on the amount requested and the lending institution, they may or may not require guarantees. It is important to compare interest rates and terms before applying for this type of loan. 2. Credit cards. Credit cards provide access to a revolving line of credit. Unlike a loan, credit cards allow you to spend up to a certain limit and pay off the debt in more flexible installments. However, credit cards tend to have high interest rates, which makes them an expensive option if you don't pay the full balance on time. 3. Mortgages. Mortgages are a type of loan used mainly for the purchase of real estate. They are long-term loans, usually 15 to 30 years, that require collateral, the property itself. Mortgage interest rates can be fixed or variable, which can affect the total cost of the loan. 4. Quick loans or microcredits. Quick loans are short-term loans that are usually granted with few requirements and without the need to justify the destination of the money. Although they are useful for covering emergencies, quick loans have very high interest rates, so they should be used with caution. 5. Business loans. Business loans are a specific form of financing for entrepreneurs and companies looking to grow. These loans can be granted by banks, investors, or specialized institutions, and usually require a detailed business plan. The interest rate and terms vary depending on the financial situation of the company and the lender. 6. Consumer credit. Consumer credit is a loan that is granted to finance the purchase of specific goods or services, such as a car or household appliances. These loans tend to have shorter terms than mortgages and require regular payments over the agreed period. Risks of resorting to financing. While financing can be a useful tool, it also carries risks that must be carefully considered. 1. Excessive debt. One of the most common risks of financing is the accumulation of debt. If loan payments are not managed properly, interest rates can cause the debt to become unpaid, leading to a cycle of indebtedness. 2. Interest and additional charges. Sources of finance are often associated with additional interest and charges that can significantly increase the cost of the products or services purchased. It is crucial to understand the terms of the loan or credit before committing. Difficulty in making repayments. If there is inadequate control of income and expenditure, it can be difficult to make loan repayments. This can lead to financial stress and affect economic stability. How to make informed decisions about financing. 1. Assess the real need. Before resorting to financing, it is important to analyze whether the money is really needed and whether the expense is in line with personal or family priorities. 2. Compare options. There are many financing options, so it is always advisable to compare different lenders, interest rates, and conditions to find the option that offers the best conditions. 3. Verify your ability to pay. Make sure you can pay back the loan or credit without compromising your financial stability. Analyze your cash flow and make sure the payments won't affect your ability to cover your essential needs. Conclusion. Financing is a powerful tool, but it must be used responsibly and conscientiously. Before resorting to external sources of money, it is crucial to assess the need, understand the terms, and ensure that the ability to pay is viable. By making informed financing decisions, we can avoid falling into over-indebtedness and use credit strategically to achieve our goals without compromising our financial stability. In the next chapter, Types of Financing and Their Characteristics, we will delve deeper into the different financing options available, their advantages and disadvantages, so that you can make more informed decisions when choosing the option that best suits your needs. Chapter 4. Types of Financing and Their Characteristics. In this chapter, we will delve into the different types of financing available, their main characteristics, and how to choose the option that best suits your financial needs. Understanding financing options is essential to making informed decisions that not only help you cover immediate expenses, but also allow you to manage your resources more efficiently in the long term. 1. Financing through personal loans. Personal loans are one of the most common forms of financing and are used to cover a variety of needs, from debt consolidation to the purchase of major assets or the financing of personal projects. Personal loans can be obtained from banks, credit unions, non-bank financial institutions, or even online lenders. Characteristics. Loan amount. Generally, personal loans offer relatively low amounts, but This can vary depending on the entity and the creditworthiness of the applicant. Interest rate. These can be fixed or variable. Fixed rates allow for predictability in payments, while variable rates can change over time. Payment term. This is usually short to medium term, generally between 1 and 5 years. Guarantee. Many personal loans do not require a guarantee, which means that they are unsecured, personal loans without collateral, although they may have higher interest rates. In some cases, a guarantee or an asset may be required. Advantages. Quick access to money. No collateral required in most cases. Ideal for covering emergencies or short-term needs. Disadvantages. Relatively high interest rates compared to other forms of financing, such as mortgages. Possibility of over-indebtedness if the use of the loan is not properly controlled. 2. Mortgages. Financing for the purchase of real estate. A mortgage is a long-term loan intended mainly for the purchase of a house or property. Unlike personal loans, mortgages tend to be for larger amounts, as they are used for the acquisition of durable goods. Mortgages are guaranteed by the value of the property being purchased, which means that if payments are not made, the lender has the right to take possession of the property. Characteristics. Loan amount. The mortgage amount can be high, depending on the value of the property and the applicant's ability to pay. Interest rate. These can be fixed or variable. Fixed rates offer stability in payments throughout the term, while variable rates can change according to market conditions. Payment term. Mortgages usually have long terms, which can be 15, 20, 25, or even 30 years. Guarantee. The home or property purchase serves as collateral in case of non-payment. Advantages. They allow you to purchase a property without needing to have all the money in cash. Relatively low interest rates compared to personal loans. Disadvantages. The long-term commitment can be a challenge if there are changes in your personal economic situation. Danger of losing the property in case of non-payment. 3. Quick loans or microcredits. Quick loans or microcredits are short-term loans characterized by their quick access and few requirements. They are often used to cover emergencies or immediate needs that cannot be financed with available money. This type of financing can be granted by banks, online lenders, credit unions, or companies specializing in quick loans. Characteristics. Loan amount. The amounts are generally small, ranging from a few hundred to a few $1,000s or the equivalent in other currencies. Interest rate. Interest rates are usually higher due to the speed with which the loans are granted. Payment term. These are usually short-term, with payment terms ranging from a few days to a couple of months. Guarantee. Generally, no guarantee is required, as these are personal loans without collateral. Advantages. Quick access to money, with approval and disbursement in a few days or even hours. Few barriers to accessing this type of credit, which makes it ideal for those with credit problems or who need money urgently. Disadvantages. Very high interest rates, which makes it an expensive option if it is not paid back quickly. Risk of falling into a cycle of debt if it is not paid back within the stipulated period. 4. Credit cards. Credit cards are another type of financing that allows people to make purchases on credit and pay later. They work like a revolving line of credit, where the available credit can be used repeatedly within the authorized limit. Credit cards are a convenient way to finance short-term purchases, but their misuse can lead to financial problems if not managed properly. Characteristics. Credit amount. The amount available depends on the credit limit established by the financial institution. Interest rate. Interest rates can be quite high, especially if the total balance is not paid within the grace period. Payment term. Payments are usually monthly and may include a portion of the principal balance plus interest. The balance can be carried over to the next month with accrued interest. Advantages. Flexibility to make purchases immediately and pay for them in installments. They offer rewards and benefits programs such as cashback or travel miles. Disadvantages. If the balance is not paid in full, interest can quickly accumulate, becoming an expensive debt. Irresponsible use of cards can lead to significant debt and affect credit scores. 5. Consumer credit. Consumer credit is a loan intended to finance the purchase of specific goods and services, such as a car, household appliances, or any other consumer item. Consumer credit usually has shorter repayment terms than mortgages, and interest rates depend on the amount requested and the lender. Characteristics. Loan amount varies according to the financial institution and the good to be financed, but in general the amounts are lower than for mortgages. Interest rate, generally higher than for mortgages, but lower than for quick loans. Payment term. Terms are usually shorter, from 1 to 5 years. Advantages. Ideal for financing purchases that do not require a loan as large as a mortgage. Payments are usually predictable, which makes planning easier. Disadvantages. Higher interest rates than on mortgage loans, which increases the total cost of credit. Can lead to debt if spending is not properly controlled. Conclusion. Each type of financing has its own characteristics, advantages, and disadvantages, and choosing the best type of financing depends on your needs, your objectives, and your financial situation. The important thing is to carefully evaluate the conditions of each option and make sure that you can meet the payments without compromising your economic stability. In the next chapter, The Psychology of Responsible Consumption, we will explore how our financial decisions, influenced by emotional and social factors, can affect our long-term economic stability. Chapter 5. The Psychology of Responsible Consumption. In this chapter, we address one of the most important aspects of managing personal finances, the psychology of responsible consumption. The way in which we make financial decisions is not always based solely on logic and needs, but is deeply influenced by emotional, social, and psychological factors. Responsible consumption involves understanding these factors and learning to make financial decisions that benefit us in the long term, avoiding momentary impulses that can damage our economic stability. What is responsible consumption? Responsible consumption is a conscious and deliberate approach to how we spend our money. Instead of making impulse or unnecessary purchases, responsible consumption is based on reflecting on our real needs and making sure that our spending is in line with our financial goals. This does not mean giving up the things we want, but doing so in an intelligent and balanced way, making sure that our purchasing decisions do not lead us into a cycle of debt or financial dissatisfaction. The psychology behind consumption. Consumption is not only a question of practical needs, but also an emotional one. There are several psychological factors that influence the way we spend, including 1. The desire for instant gratification. Impulse buying is often a response to the desire for immediate satisfaction. In many cases, people buy things without thinking about the long-term consequences, simply because the act of buying provides a feeling of immediate pleasure. This impulse can be difficult to control, especially in an environment where shopping options are increasingly accessible and convenient, thanks to online shopping and special offers. 2. Consumption as a way of filling emotional voids. People often turn to consumption as a way of dealing with negative emotions such as stress, anxiety, or personal dissatisfaction. Shopping can be a way of escaping from uncomfortable feelings, offering a temporary sense of control or satisfaction. This type of consumption is known as emotional consumption and can result in a cycle of impulsive purchases that do not address the root of the emotional problem, but only aggravate it in the long term. 3. Social pressure and comparative consumption. We live in a society that places a high value on consumption and the status it can represent. Social networks, advertising, and the influences of our environment play a key role in the way we perceive what is necessary or desirable. The desire to belong, to have what others have, or to project an image of success can lead us to make purchasing decisions based more on external expectations than on our true needs. 4. Belief in happiness through shopping. Many people believe that happiness and personal fulfillment can be found through the acquisition of material goods. This belief may be rooted in our consumer culture, where we are constantly shown that having more things will make us happier. However, the reality is that material goods only provide temporary satisfaction and rarely contribute to lasting happiness. The consequences of irresponsible consumption. Irresponsible consumption, driven by instant gratification, social pressure, or the need to fill emotional voids, can have serious consequences for our financial stability. The main consequences include 1. Over-indebtedness. Buying products that are not really necessary, especially when financed through credit cards or loans, can lead to an accumulation of debt. This excessive indebtedness can create a cycle in which interest payments and accumulated debts become difficult to manage, affecting both the financial and emotional health of individuals. 2. Lack of savings and investment. Impulse spending and the unnecessary purchase of material goods reduce the ability to save or invest in important goals, such as retirement, an emergency fund, or an investment in education. The lack of adequate savings can lead to difficult financial situations in the future. 3. Continuous dissatisfaction. Impulse buying can lead to a cycle of continuous dissatisfaction, as purchases do not resolve deep emotional problems or feelings of emptiness. By not addressing the underlying causes of dissatisfaction, the individual can fall into a spiral of consumption to fill an emotional need, which can result in a perpetual cycle of dissatisfaction. Principles for responsible consumption. 1. Evaluate needs versus wants. One of the first keys to responsible consumption is learning to differentiate between what we need and what we simply want. Needs are goods and services that are essential for our daily life and our well-being, such as food, housing, and health. Wants are products or services that are not essential, but that often seem attractive to us due to advertising, social influences, or the desire for instant gratification. A good exercise is to carry out an analysis before making a major purchase. Ask yourself if you really need that item or if it is just an impulse purchase. If the answer is that you don't need it, then it is best to postpone the purchase and assess whether the need still exists after a few days. 2. Set a budget for non-essential purchases. It is important to be aware of how much money is spent on impulse or non-essential purchases. Setting a monthly limit for these types of purchases can help avoid overspending. The budget should be flexible, but should also include a percentage set aside for savings and priority expenses. 3. Practice delayed gratification. Delayed gratification is the act of resisting the desire to make an immediate purchase and instead waiting until the need or desire is more considered. This approach helps to avoid impulse buying and encourages a more rational attitude towards consumption. 4. Reflect on emotions when shopping. Before making a purchase, it is useful to reflect on the emotions behind that decision. Ask yourself if the purchase is being motivated by a negative emotion, such as stress or anxiety, and if the object of purchase will really solve that emotional need. If the answer is no, it is best to reconsider the purchase. 5. Educate others about responsible consumption. Financial education is not only important for us, but also for family members, especially the youngest. Teaching children and teenagers about the value of money, the importance of saving, and how to shop responsibly from an early age is essential for them to also grow up with a healthy financial mindset. Conclusion. The psychology of responsible consumption is a key component in personal financial management. Being aware of the emotional, social, and psychological influences that affect our purchasing decisions is the first step towards healthier and more balanced consumption. By differentiating between needs and wants, practicing delayed gratification, and setting financial limits, we can live within our means and create a more stable economic future. Remember that consumption does not have to be synonymous with dissatisfaction, but rather a tool to improve our quality of life in a thoughtful and responsible way. In the next chapter, Personal Loans, an in-depth analysis, we will explore personal loans, how to choose the best ones for our needs, and how to use them responsibly to avoid falling into unnecessary debt. Chapter 6. Personal Loans, an in-depth analysis. In this chapter, we dive into personal loans, one of the most common forms of financing used to meet immediate needs, pay off debts, or finance personal projects. Personal credit is a useful tool when you need cash quickly and don't have enough savings or funds available. However, it is important to have a good understanding of how these credits work, the conditions offered by financial institutions, and how to use them responsibly to avoid debt problems. What is personal credit? A personal loan is a loan granted to an individual, generally for specific purposes such as the purchase of a vehicle, debt consolidation, financing studies, or home remodeling. Unlike mortgages or consumer loans, which are intended for specific goods, such as a house or a car, personal loans are generally granted in cash and can be used for any purpose, which offers flexibility when managing funds. Characteristics of personal loans. 1. Loan amount. Personal loans can vary in the amount granted. The amounts are usually less than a mortgage or car loan, but they can be enough to cover significant expenses or personal projects. The The amount that can be requested depends on factors such as the applicant's income, credit history, and the lender's policy. 2. Payment term. Personal loan terms vary, but generally range from 1 to 5 years. The longer the term, the lower the monthly payments, but the higher the total cost of the loan due to interest accrued over time. It is important to choose a term that fits your ability to pay. 3. Interest rate. Interest rates are a fundamental part of any personal loan. They can be fixed or variable. Fixed rates offer stability, as the interest percentage will not change during the life of the loan. Variable rates, on the other hand, can be adjusted over time according to market conditions, which can generate fluctuations in monthly payments. Interest rates on personal loans are usually higher than on mortgages due to the smaller amount borrowed and the risk perceived by the lender. 4. Eligibility requirements. To obtain a personal loan, most financial institutions require the applicant to have a good credit history and a stable source of income. In addition, lenders often review the person's current level of indebtedness to ensure that they are not overburdened with too many financial commitments. 5. Collateral. Many personal loans are unsecured, which means that no asset is required as collateral to obtain a loan. However, some lenders may offer better terms to those who are willing to provide collateral, such as a vehicle or property, which reduces the risk to the lender. Advantages of personal loans. 1. Flexibility. One of the main advantages of personal loans is the flexibility they offer. You can use the money for a variety of purposes, giving you the freedom to make financial decisions based on your needs and priorities. From financing a trip or remodeling the house to consolidating debts, personal loans allow for a wide range of uses. 2. Quick and easy process. Obtaining a personal loan is usually a relatively quick process. Many lenders, especially banks and online lenders, allow you to apply for credit online, with quick approvals in a matter of hours or days, depending on the situation. This speed is very useful when you need money urgently. 3. No collateral required. In most cases, most personal loans do not require collateral, which means that you will not have to put your assets at risk to obtain the loan. However, you must be prepared to repay the debt according to the established terms. Disadvantages of personal loans. 1. High interest rates. Interest rates on personal loans are usually higher than on other types of loans, such as mortgages or car loans. This is because personal loans are generally unsecured and the lender assumes a higher risk. High interest rates can make the total cost of credit significantly higher, especially if the loan is repaid over a long period of time. 2. Risk of over-indebtedness. If not managed properly, personal loans can contribute to a cycle of indebtedness. With easy access to extra money, some people tend to spend more than they should or take out new loans to pay off previous debts, which creates a vicious circle of debts that are difficult to control. 3. Impact on credit score. Failure to repay personal credit as agreed can negatively affect your credit history. Default or delinquency can damage your credit score, making it difficult to obtain future loans at favorable rates. How to choose the best personal credit. Choosing the right personal credit is an important decision that requires consideration of several factors. Here are some key recommendations to make an informed decision. 1. Compare interest rates. Not all lenders offer the same interest rates. It is essential to compare the rates of different financial institutions before committing to a loan. A small change in the interest rate can have a big impact on the total cost of the loan. 2. Review the loan conditions. In addition to the interest rate, be sure to review other credit conditions, such as origination fees, repayment terms, late payment penalties, and refinancing clauses. Make sure you understand all the implications before signing the contract. 3. Assess your ability to pay. Before applying for credit, assess your ability to pay. Don't be swayed by the amount of the loan available, but by what you can really afford to pay. If you have doubts about your ability to make the payments, it is better to opt for a smaller amount or explore other financing options. 4. Consider payment flexibility. Some lenders allow for greater payment flexibility, such as the possibility of making advance payments or modifying the terms in case of difficulties. This flexibility can be useful if your financial situation changes unexpectedly. The importance of using personal loans responsibly. Personal credit is a powerful tool, but it also comes with responsibility. To avoid falling into a cycle of debt and affecting your financial stability, it is essential to use personal credit responsibly. You should only apply for credit if you really need it and if you are sure that you will be able to make the payments according to the established plan. Well-managed credit can be an excellent way to finance your projects without compromising your financial future. Conclusion: personal loans are a useful option for financing immediate needs or personal projects, but they should be used with caution. Before applying for a loan, it is important to evaluate all the conditions, compare options, and make sure that you can make the payments without affecting your financial health. With proper use, a personal loan can be a powerful tool that allows you to achieve your goals without falling into the traps of excessive debt. In the next chapter, the mortgage, long-term investment or financial risk, we will explore how a mortgage works, what to consider before applying for one, and how to effectively manage this type of long-term debt. Chapter 7. The mortgage, long-term investment or financial risk. In this chapter, we analyze one of the most important aspects of personal finance, the mortgage. For many people, the mortgage is the largest and longest-lasting loan they will take out in their lifetime. Buying a house is a common goal, but it is crucial to fully understand how mortgages work and how to manage them effectively to prevent them from becoming a financial burden. Throughout this chapter, we will explore the advantages and disadvantages of mortgages, the factors you should consider before applying for one, and how to make smart decisions that will help you manage this type of debt in the long term. What is a mortgage? A mortgage is a type of long-term loan that is used primarily for the purchase of real estate, such as a home or commercial property. The property purchase serves as collateral for the loan, which means that if the payments are not met, the lender has the right to take possession of the property. Mortgages are a common form of financing due to the high cost of housing and the inability of most people to pay for a property in full right away. Characteristics of mortgages. Loan amount. The mortgage amount generally refers to a percentage of the value of the property you wish to buy. In most cases, lenders require the buyer of the property to pay a down payment, which is usually between 10% and 20% of the value of the property. The rest of the price is financed through the mortgage loan. 2. Mortgage term. Mortgages have long terms, typically 15, 20, or 30 years. The longer the term, the lower the monthly payment, but the total cost of the mortgage, including interest, will be higher. Shorter terms generally have higher monthly payments, but in the long run you pay less in interest. 3. Interest rate. There are two main types of mortgage interest rates, fixed and variable. Fixed rate. This means that the interest rate does not change throughout the term of the loan. This provides certainty in the monthly payments, as they will not depend on market fluctuations. Variable rate. The interest rate can change during the life of the loan according to market conditions, which could cause monthly payments to vary. 4. Repayment. Amortization refers to the process of paying off the loan over time, which generally includes both principal and interest payments. In the early stages of the mortgage, a larger portion of the monthly payments goes towards interest, but as the term progresses, a greater proportion of the payment goes towards reducing the principal balance of the loan. 5. Collateral. The property you buy with the mortgage loan serves as collateral or security for the loan. If you cannot make the agreed payments, the lender has the right to initiate legal proceedings to take the property, a process known as foreclosure. Advantages of mortgages. 1. Access to property without the need for full savings. Mortgages allow people to buy a home without having to save 100% of the property's value. This facilitates access to property for those who cannot raise large sums of money immediately. 2. Lower interest rates than other loans. Mortgages tend to have lower interest rates than other types of personal loans because they are secured by the property being purchased. This makes a mortgage a more accessible and affordable financing option compared to other types of credit. 3. Wealth building. As you pay off your mortgage, you build equity in the property, meaning that your percentage ownership increases with each payment. In the long term, this can mean significant value in terms of personal wealth, especially if the property increases in value over time. 4. Tax benefits. In some countries, mortgage interest payments may be tax-deductible, helping to reduce the effective cost of a loan. This can vary according to the tax legislation in each country, so it is important to consult with a tax advisor about possible deductions. Disadvantages of mortgages. 1. Long-term commitment. Mortgages generally require a long-term payment commitment, often 15, 20, or 30 years. This can be a disadvantage if personal circumstances change, such as moving house, changing jobs, or getting divorced. Monthly payments can be difficult to manage if they do not fit in with your financial situation. 2. Additional costs. Mortgages involve not only monthly loan repayments, but also a series of additional costs, such as property insurance, property taxes, closing fees, and other administrative charges. These costs can add up to a significant amount to the total price of the property. 3. Risk of foreclosure. If you are unable to make your mortgage payments, there is a risk that the lender will initiate foreclosure proceedings, which means you would lose your property. This is a significant risk, especially if interest rates rise or if your financial situation changes unexpectedly. 4. Variable interest rate. Mortgages with variable interest rates may be initially attractive due to lower rates, but they present the risk that payments will increase if rates rise over time. It is important to keep in mind that variable rates can make monthly payments unpredictable. How to choose the best mortgage. 1. Assess your needs and ability to pay. Before applying for a mortgage, it is crucial that you assess your ability to pay. Make sure that the monthly payments do not exceed 30% of your monthly income, which is a general standard for maintaining a balance in your finances. Don't rush into buying a property you can't afford. 2. Compare interest rates. The interest rate is one of the most important factors when choosing a mortgage. Compare the rates offered by different lenders and consider whether you prefer a fixed or variable rate, depending on your expectations about market developments. 3. Consider the term of the mortgage. Longer terms may seem attractive because they have lower monthly payments, but in the long run, you'll pay more in interest. Consider whether a shorter term with higher monthly payments may be a more economical option in the long term. 4. Research additional costs. Don't limit yourself to monthly payments. Make sure you know all the additional costs, such as insurance, property taxes, and closing fees, to get a complete picture of the total cost of the mortgage. Mortgage as a long-term investment. Buying a house through a mortgage is, in many cases, a long-term investment. While it can be a financial burden in the short term, over time, you may see an appreciation in the value of the property, which would increase your personal wealth. In addition, as you pay off the mortgage, your percentage of ownership in the home grows, which can provide you with significant financial security in the future. Conclusion. Mortgages are a powerful tool for acquiring a home, but they also represent a significant financial commitment. Before applying for a mortgage, it is essential to understand its characteristics, the costs involved, and your ability to pay. Making an informed decision will help you enjoy the benefits of home ownership without compromising your financial stability. The key is to choose a mortgage that suits your needs, your financial situation, and your long-term goals. In the next chapter, Credit and Debit Cards, Short-Term Financing Tools, we will explore how credit and debit cards work, their advantages and disadvantages, and how to use them responsibly to optimize your personal finances. Chapter 8. Credit and Debit Cards, Short-Term Financing Tools. Credit and debit cards are commonly used financial tools that facilitate everyday purchases and access to credit. However, each of these cards has very different characteristics and functions, which makes it important to understand how to use them correctly to avoid financial problems. This chapter delves into how both cards work, their advantages and disadvantages, and how to use them responsibly. What is a credit card? A credit card is a tool that allows you to make purchases or withdraw money up to a pre-established limit, known as a credit limit. Unlike debit cards, which only allow you to spend the money that is already in your bank account, credit cards allow you to spend borrowed money, which you must pay back with interest. Characteristics of credit cards. 1. Credit limit. The credit limit is the maximum amount you can spend with a card. This limit is determined by the card issuer, taking into account factors such as your income, your credit history, and your ability to pay. The higher your credit limit, the more you can spend, but you will also have a greater responsibility in terms of payments. 2. Interest rates. Credit cards tend to have high interest rates, especially if you don't pay the balance in full within the grace period. Interest rates vary between institutions and types of cards, but in general, they are significantly higher than other credit products, such as personal loans or mortgages. 3. Grace period. Credit cards usually offer a grace period, which is the time during which no interest is charged on the balance if the total debt is paid before the due date. If you do not pay the full balance within this period, interest will start to be charged, and this will accumulate on the outstanding balance. 4. Minimum payments. If you cannot pay the full balance, credit cards require a minimum monthly payment. This minimum payment is usually a small percentage of the total balance or a fixed amount, depending on the issuer. If you only pay the minimum, interest can cause the debt to grow quickly. 5. Additional benefits. Many credit cards offer benefits such as rewards for purchases, for example, points, frequent flyer miles, or cashback, travel insurance, purchase protection, and exclusive discounts. These benefits can make using a credit card more appealing, but it's important not to get carried away by the incentives if you can't pay off the debt on time. Advantages of credit cards. 1. Payment flexibility. Credit cards allow you to make purchases without having to pay immediately. This is useful for large or unexpected purchases, as you can pay the balance in installments as long as it is managed responsibly. 2. Improved credit history. Using a credit card responsibly and paying off the balance on time can improve your credit history, which, in turn, can help you obtain better conditions on future loans or credit. 3. Additional benefits. Credit cards can offer additional benefits such as rewards programs, discounts, insurance, and purchase protection, making them an attractive option for those who benefit from these extras. 4. Emergencies. In the event of financial emergencies, credit cards offer a quick way to access money. This is especially useful in situations where you don't have enough cash available, such as medical emergencies or unexpected repairs. Disadvantages of credit cards. 1. High interest rates. If you do not pay the full balance within the grace period, credit card interest rates can be very high, increasing the cost of what you initially paid. Interest can accumulate quickly and make the debt more difficult to manage. 2. Debt cycle. Overusing credit cards and not paying off your debts can create a cycle of indebtedness, where each month more interest accumulates and the outstanding balance increases. This can lead to serious financial problems and affect your credit score. 3. Late payment fees. Credit cards often impose additional charges if the minimum payment is not made on time. These charges can be high and add more debt to the outstanding balance. 4. Risk of misuse. Credit cards can encourage impulsive spending and overconsumption, which can lead to financial problems if you don't have proper control of your budget and expenses. What is a debit card? On the other hand, a debit card works differently to a credit card. With a debit card, you can only spend the money you have available in your bank account. You are not borrowing, but using your own funds to make purchases or ATM withdrawals. Debit card features. 1. Balance base limit. The limit of a debit card is determined by the available balance in the associated bank account. If there is not enough money in the account, you will not be able to make the purchase unless you have a line of credit linked to the account. 2. No interest. Debit cards do not have interest rates, as you are not borrowing money. You only spend what you have available, so you do not accumulate debt or interest. 3. Convenience and security. Debit cards are widely accepted and offer a secure way to make payments without having to carry cash. In addition, most debit cards offer fraud protection and the ability to block the card if it is lost or stolen. Advantages of debit cards. 1. Expense control. Since you can only spend what you have in your account, debit cards are an excellent way to avoid over-indebtedness. There is no risk of accumulating debt, and payments are deducted directly from the available balance. 2. No interest charges. Since you are not borrowing money, there are no interest charges, making the debit card an economical option if you only need access to your own money. 3. Ease of use. Debit cards are easy to use and widely accepted. You can use them to make online purchases, pay in physical stores, or withdraw money from ATMs. Disadvantages of debit cards. 1. No additional benefits. Unlike credit cards, debit cards tend to offer fewer benefits, such as rewards programs or purchase protection. 2. Risk of fraud. Although debit cards offer protection against fraud, if your card is compromised, the money is withdrawn directly from your bank account. This can be problematic if you cannot quickly recover the stolen funds. Conclusion. Credit and debit cards are useful tools for managing money, but they must be used responsibly. Credit cards offer flexibility and additional benefits, but irresponsible use can lead to debt problems. Debit cards, on the other hand, are an excellent way to control spending and avoid debt, but they offer less flexibility and fewer benefits. It is essential to understand how both options work and how to use them wisely. If you can manage your expenses properly, credit cards can be a valuable tool for building your credit history and accessing resources when you need them. On the other hand, if you prefer to avoid the complications of credit, debit cards offer you a more controlled way of managing your money. In the next chapter, using quick loans, benefits and risks, we will explore quick loans, how they work and when it is advisable to use them, always with a focus on responsible money management. Chapter 9. Using fast credit, benefits and risks. In this chapter, we will analyze fast credit, a form of financing that has gained popularity in recent years, especially for covering emergencies or immediate cash needs. Fast credit, also known as microcredit or quick loans, offers immediate access to cash, making it an attractive option in situations where money is needed quickly. However, like any financial product, payday loans have both benefits and risks. It is important to understand how they work, when they are useful, and how to use them responsibly to avoid getting into financial trouble. What are payday loans? Payday loans are short-term loans that are granted for relatively small amounts and are characterized by their speedy approval and disbursement process. These loans often do not require many application requirements and can be approved in minutes or a few hours. Due to their accessibility, quick loans are ideal for people facing emergencies or unexpected expenses, such as urgent home repairs, medical bills, or even unforeseen trips. Characteristics of quick loans. Loan amount. The amounts of quick loans are generally low, ranging from a few hundred to several thousand monetary units, depending on the lender. Due to the nature of the loan, large sums of money are not usually granted, but are limited to immediate and short-term needs. 2. Payment term. Quick loans usually have very short repayment terms, which generally range from a few days to a few months. Short terms can be advantageous in terms of the speed with which the debt can be repaid, but they can also cause difficulties if you do not have enough money to cover the debt within that period. 3. Application and approval process. One of the most attractive features of quick loans is the ease of access. Applications can be made online or by telephone, and approval is quick, often without the need to present proof of income or go through complicated procedures. This speed is an advantage in emergency situations, but it also means that the lender may have less control over the applicant's real ability to repay. 4. Interest and charges. Quick loans tend to have significantly higher interest rates than other types of loans, such as mortgages or traditional personal loans. In addition, some lenders may add additional fees or charges for the management or disbursement of the loan. It is important to read the terms and conditions carefully before accepting any quick loan, as interest and charges can add up quickly. Advantages of quick loans. 1. Immediate access to money. Quick loans are an excellent solution when money is urgently needed and there is no immediate access to other forms of financing. This immediacy makes them an attractive option for emergency situations, such as home repairs, medical expenses, or unforeseen trips. 2. Quick and easy process. Applying for a quick loan is generally quick and easy. Most lenders allow the entire process to be completed online, making it easy to get the money without having to wait for days or weeks. In addition, approval and disbursement can be done in a matter of hours. 3. No income justification required. Unlike traditional loans, which require extensive documentation, many quick loans do not require proof of income or a perfect credit history. This makes them an accessible option for people with limited credit history or who do not have access to conventional financial products. 4. Ideal for urgent needs. If you have an urgent need for money and can't wait, quick loans may be the right solution. Whether it's to cover an emergency or deal with an unexpected expense, these loans give you quick access to money. Disadvantages of quick loans. 1. High interest rates. The main disadvantage of quick loans is their high cost in terms of interest rates. Since they are short-term loans with no collateral, lenders assume a higher risk, which is reflected in the high interest rates. If the balance is not paid within the agreed period, the interest can increase considerably. 2. Risk of over-indebtedness. Quick loans can be a solution in emergencies, but their easy access and short terms can lead to excessive debt if not managed properly. If not paid on time, interest and additional charges can cause the outstanding balance to grow rapidly, which can lead to long-term financial problems. 3. Unclear conditions. Some payday lenders are not transparent about loan conditions, such as interest rates and additional fees. It is important to read the terms and conditions carefully before accepting the loan to avoid unpleasant surprises. 4. Impact on credit history. Irresponsible use of quick loans can negatively affect your credit history. If you cannot repay the loan on time, this may be reflected in your credit score, making it more difficult to obtain other loans or credit in the future. When is it appropriate to use a quick loan? Quick loans are useful in emergency situations, but they should be used with caution. Here are some situations where it might be appropriate to resort to a quick loan. Medical emergencies. If you have unexpected medical expenses that can't wait until next month, a quick loan can help you cover those costs immediately. Urgent repairs. If you have a major repair at home, such as a problem with the plumbing or appliances, and you can't pay for it right away, a quick loan can help you fix the problem. Unexpected expenses. If you face unexpected expenses that can't be covered by your savings, a quick loan can give you the flexibility to manage them. How to use quick loans responsibly. 1. Don't use them regularly. Quick loans should be used only in emergency situations, not as a regular money management solution. Using them regularly can lead to a cycle of debt that is difficult to break. 2. Pay on time. It is essential that you pay off the quick loan within the grace period to prevent interest from increasing. If you can't pay off the full balance, try to minimize additional charges by making a larger payment than the minimum required. 3. Read the terms and conditions. Make sure you read all the terms and conditions of the quick credit before accepting the loan. Understand the interest rates, fees, and terms to avoid surprises that could increase the cost of the credit. 4. Avoid impulsive use. Do not use quick credits to finance non-essential purchases or to cover non-urgent expenses. Think about the long-term consequences before making the decision to apply for a quick credit. Conclusion. Quick loans are a useful tool in emergency situations, but they should be used responsibly and with caution. Although they offer immediate access to money, the high interest rates and short terms can make them an expensive solution if they are not managed properly. Make sure that quick loans are a viable option for your financial situation and always look for alternatives if possible. In the next chapter, Debt Refinancing, a financial rescue strategy, we will look at how refinancing can help you manage and reduce existing debts, improving your long-term financial health. Chapter 10, Debt Refinancing, a financial rescue strategy. In this chapter, we are going to explore debt refinancing, a strategy that can be key to improving your financial situation if you find yourself overwhelmed by multiple debts with high interest rates or high monthly payments. Refinancing allows you to restructure your debts under new conditions, which can reduce your monthly payments, lower the interest rate, and make it easier to pay off your debts in the long term. Throughout this chapter, we will analyze how refinancing works, when it is useful, and what factors you should take into account before making this financial decision. What is debt refinancing? Debt refinancing is the process of replacing a loan or several existing debts with a new loan that has more favorable conditions. This generally involves obtaining a new loan with a lower interest rate, a longer term, or both, allowing you to pay off the original debts in a more affordable way. Instead of continuing to pay multiple debts with different due dates and interest rates, refinancing allows you to consolidate them into a single debt with more manageable payments. How does debt refinancing work? Debt refinancing involves taking out a new loan, usually at a lower interest rate, to pay off existing debts. The process includes several important steps. 1. Evaluation of existing debts. The first thing to do is to review all your current debts, including credit cards, personal loans, mortgages, etc. Write down the amount of each debt, the interest rate, and the monthly payments. This will allow you to identify the most expensive debts, i.e., those with the highest interest rates, and decide which of them could benefit most from refinancing. 2. Look for a favorable refinancing offer. Once you have a clear idea of your debts, it's time to look for a refinancing loan. This may involve going to banks, credit unions, or online lenders. Look for an offer with a lower interest rate than what you are currently paying on your debts. It is also important to consider the repayment term. A longer term may reduce monthly payments, but will increase the total cost of the debt due to accrued interest. 3. Apply for the refinancing loan. Once you find an offer that suits your needs, you will need to apply for the refinancing loan. Lenders will generally assess your creditworthiness and income to determine whether you are a good candidate for refinancing. If your financial situation has improved since you took out the original debts, you are likely to get better terms. 4. Pay off the original debts. With the funds obtained from the refinancing loan, you will pay off all your previous debts. This will stop being a multiple payment problem and will consolidate them into a single debt. From now on, you'll only have to make a single monthly payment to the lender who granted the refinancing loan. 5. Establish new payments. Now that you have a single loan with better conditions, you will have to make a single monthly payment. Payments may be lower if you have managed to reduce the interest rate or extend the term of the loan. It is important to be disciplined and make payments on time to avoid falling back into the debt cycle. Advantages of debt refinancing. 1. Lower interest rate. One of the main advantages of refinancing is the possibility of obtaining a lower interest rate on the new loan. This reduces the total cost of the debt, which means you will pay less in interest over time. 2. Lower monthly payments. If you choose a refinancing loan with a longer term, your monthly payments can be significantly reduced. This offers you temporary relief, especially if you are struggling to cope with high payments on several debts. However, you should bear in mind that if you extend the term, you could end up paying more in total due to the additional interest. 3. Debt consolidation. Refinancing allows you to consolidate multiple debts into a single loan, making it easier to manage your payments. You will no longer have to make payments to different lenders on different dates. You will only have to make a single monthly payment, which reduces the risk of forgetting a payment or paying late. 4. Improved credit score. If you use refinancing to consolidate debts and pay them on time, you could see an improvement in your credit score. Paying off existing debts helps to reduce your level of indebtedness and demonstrates to lenders that you are responsible with your payments. 5. Greater flexibility. Refinancing can offer you more flexibility in terms of the loan. If you are having difficulties with your current payments, refinancing allows you to renegotiate the terms and conditions to make the payments more affordable. Disadvantages of debt refinancing. 1. Possible additional charges. Some lenders may charge fees for refinancing, such as origination fees, commissions, or prepayment charges. Be sure to read all the terms and conditions before making a decision to avoid surprise charges that can reduce the benefits of refinancing. 2. Higher interest if the term is extended. If you decide to extend the term of the refinancing to reduce monthly payments, you may end up paying more interest in total, even if the interest rate is lower. A longer term means more time during which interest can accrue. 3. Unresolved debts. Refinancing does not solve the debt problem itself. Without changing spending behavior or making an effort to reduce other expenses, it is easy to fall back into debt. Refinancing only helps if a disciplined approach to money management is adopted in the future. 4. Requires a good credit history. To obtain a refinancing with favorable conditions, you will generally need to have a good credit score. If your credit is not in good condition, you could get a higher interest rate, which could make refinancing not so advantageous. When is it advisable to refinance your debts? Refinancing is most effective when 1. You have several debts with high interest rates. If you have several credit cards or other loans with high interest rates, refinancing can help you consolidate those debts at a lower rate, which will reduce the total cost of the debt. 2. You can't handle the monthly payments. If the payments on your current debts are too high for your budget, refinancing can give you some breathing space by reducing the monthly payments and giving you more time to pay. 3. You have improved your credit situation. If your credit score has improved since you acquired the original debts, you may qualify for a loan with better conditions, which will allow you to reduce interest and make payments easier. 4. You have not fallen into a cycle of indebtedness. Refinancing is a useful tool for those who need to restructure their debts, but it is not a solution for those who continue to incur debts out of control. You must be disciplined and avoid accumulating more debt after refinancing. Conclusion: debt refinancing can be an excellent strategy for improving your financial health if used properly. It allows you to reduce your monthly payments, consolidate debts, and potentially obtain a lower interest rate. However, it is important to understand the terms of the loan and make sure that refinancing is a viable and responsible solution for your financial situation. While refinancing can offer temporary relief, the key is to change financial habits and avoid falling back into the debt cycle. In the next chapter, The Dangers of Over-Indebtedness, we will explore the risks associated with excessive indebtedness and how to avoid falling into financial traps that can damage your economic stability. Chapter 11. The Dangers of Over-Indebtedness. In this chapter, we are going to explore one of the biggest financial risks we face in everyday life: over-indebtedness. Living beyond our means and accumulating more debt than we can handle not only jeopardizes our economic stability, but also affects our peace of mind and overall well-being. Understanding the dangers of over-indebtedness and how to avoid it is critical to maintaining a healthy financial future. Throughout this chapter, you will learn how to identify the signs of over-indebtedness and how to take steps to free yourself from the burden of excessive debt. What is over-indebtedness? Over-indebtedness occurs when a person or family has more debts than they can pay, resulting in an unsustainable financial burden. This phenomenon is usually the result of spending more than one earns, accumulating multiple debts with high interest rates, and not having a clear plan to pay off the outstanding balance. If steps are not taken to control and reduce debt, over-indebtedness can lead to serious financial consequences, such as insolvency, foreclosure, or bankruptcy. Causes of over-indebtedness. 1. Excessive spending. One of the main factors contributing to over-indebtedness is excessive spending. If you constantly spend more than you earn, whether on basic necessities or unnecessary luxuries, debt accumulates quickly. Impulse buying, overuse of credit cards, or a lack of control over spending can lead to a mountain of debt that is difficult to manage. 2. Lack of financial planning. The lack of an adequate budget and a clear financial plan can be a major cause of over-indebtedness. Without detailed monitoring of income and expenditure, it is easy to fall into the trap of spending more than you can afford, especially when you don't have a clear idea of your personal finances. 3. Emergencies and unforeseen expenses. Emergencies, such as medical problems, car repairs, or job loss, can lead people to resort to credit to cover unforeseen expenses. Without an adequate emergency fund, these situations can force people to resort to high-interest loans, which contributes to over-indebtedness. 4. Excessive use of credit cards. Credit cards are a useful tool when used responsibly, but if not properly monitored, they can become a dangerous trap. Spending more than you can afford at the end of the month and only making minimum payments can lead to a rapid accumulation of high-interest debt. 5. Unfavorable economic conditions. External factors, such as an economic recession, job loss, or a decrease in family income, can make it more difficult to meet debt payments. In these cases, over-indebtedness can be the result of a combination of circumstances beyond the person's control. Consequences of over-indebtedness. 1. Financial stress. One of the most immediate effects of over-indebtedness is the stress it generates. Constant worry about how to pay debts, anxiety about overdue payments, and the pressure of threats of foreclosure or cutoff of services can seriously affect a person's mental and emotional health. 2. Damage to credit history. Failure to make debt payments negatively affects credit history, lowering credit scores. A low credit score can make it difficult to obtain new credit in the future and can result in much higher interest rates, further worsening the financial situation. 3. Risk of foreclosure or eviction. If a person cannot meet their mortgage payments, the lender can initiate a foreclosure process, which can lead to the loss of the home. This is one of the most serious risks of over-indebtedness, as housing is one of the most important assets for many people. 4. Impact on personal relationships. Over-indebtedness can also generate conflicts within family and personal relationships. Arguments about money, stress related to debts, and concerns about the future can create significant tension, affecting family and personal harmony. 5. Personal bankruptcy. If over-indebtedness gets out of control and measures are not taken in time, the person may face bankruptcy. Bankruptcy is a legal solution to eliminate or reorganize debts, but it has serious and lasting consequences for the person's financial situation, such as loss of assets, reduced ability to access credit in the future, and a negative impact on credit history. How to avoid over-indebtedness. 1. Create and follow a budget. The key to avoiding over-indebtedness is to have a clear and detailed budget that allows you to keep track of your income, your expenses, and your savings. The budget will help you identify what you are spending more on than you should and adjust your spending habits to live within your means. It is essential to set aside a fixed amount for savings and debt repayment each month. 2. Set up an emergency fund. Having an emergency fund is essential to cover unforeseen expenses without having to resort to credit. This fund should be made up of enough money to cover between 3 and 6 months of essential expenses and should be kept in an easily accessible savings account. 3. Avoid impulse buying. Impulse buying is one of the main causes of over-indebtedness. Before making a purchase, ask yourself if you really need it or if it is just a momentary desire. If possible, wait 24 hours before making a decision, which will give you time to think about the purchase. 4. Use credit cards responsibly. Credit cards should be used with care. Don't spend more than you can afford at the end of the month, and always try to pay the balance in full to avoid accumulating interest. If you can't pay the balance in full, minimize your payments and try to reduce your debt as quickly as possible. 5. Refinance high-interest debts. If you have multiple debts with high interest rates, consider refinancing them or consolidating them into a single loan with better conditions. This can reduce the amount of your monthly payments and allow you to pay off your debts more quickly. 6. Seek professional help. If you are already dealing with over-indebtedness, it is advisable to seek the help of a financial advisor or debt expert. They can help you create a plan to get out of debt and prevent the situation from getting worse. Conclusion. Over-indebtedness is a serious financial danger that can have devastating consequences for your economic, mental, and emotional stability. However, it is possible to avoid it through prudent financial management, budgeting, saving, and making responsible consumer decisions. If you are already in a situation of over-indebtedness, it is important to act quickly to avoid more serious consequences, such as foreclosure or bankruptcy. Always remember that the key is to live within your means and plan for the future. In the next chapter, How to Avoid Overdrafts and Bank Fees, we'll explore how to manage bank accounts and avoid additional fees that can affect your budget and your financial health. Chapter 12. How to Avoid Overdrafts and Bank Fees. In this chapter, we address how to manage bank accounts efficiently to avoid unnecessary charges, such as overdraft and bank fees. Bank fees are an expense that many people overlook, but they can add up quickly and affect your financial stability. Throughout this chapter, we will explore what these fees are, how they can impact your finances, and best practices for avoiding them and managing your money more effectively. What is an overdraft? An overdraft occurs when you try to make a payment or withdraw money from a bank account without having enough funds to cover the transaction. The bank allows the transaction to be completed, but the account balance becomes negative. This results in overdraft charges, which can vary depending on the bank and the type of account. Although it can be useful in emergencies, overdrafting can have negative financial consequences if not handled properly. How to avoid overdrafts. 1. Keep track of your balance. The most effective way to avoid overdrafts is to keep proper track of your bank balance. If you know how much money you have available in your account at all times, you will be less likely to make payments or withdrawals without sufficient funds. Use mobile apps or online tools provided by your bank to check your balance and transactions in real time. 2. Set up low balance alerts. Many banks offer the option of setting up automatic alerts when your balance falls below a set amount. These alerts can help you avoid overdrafts by reminding you that your balance is low before you make a transaction. Set up these alerts to keep you informed about your account status and to act in advance. 3. Review pending transactions. Some transactions, such as checks or automatic payments, may not be immediately reflected in your balance. Make sure you take pending transactions into account and consider these payments when doing your calculations to avoid last-minute surprises. 4. Create a reserve fund. Having a reserve fund or financial buffer in your checking account can be useful to cover the unexpected and avoid overdrafts. This fund should not be used for regular expenses, but only for emergencies, giving you a safety margin in case your balance approaches zero. 5. Opt for an account with no overdraft. Some banks offer checking accounts with no overdraft protection, which means that transactions exceeding the available balance in the account are not allowed. If you are prone to making mistakes and overlooking transactions, an account with no overdraft protection may be an option to avoid additional charges. What are bank fees? Bank fees are charges that banks impose for various services, such as account maintenance, withdrawals from other banks' ATMs, money transfers, check issuance, among others. These charges may seem small individually, but if not managed properly, they can add up quickly and affect your monthly budget. Common types of bank fees. 1. Account maintenance fee. Many banks charge a monthly fee for maintaining a checking or savings account. However, some banks offer accounts with no fees if you meet certain requirements, such as maintaining a minimum balance or making a specific number of transactions per month. 2. ATM usage fee. If you use an ATM belonging to a bank other than your own, you are likely to be charged a commission. This fee can vary, but it is generally a fixed charge per transaction. To avoid these types of commissions, try to use the ATMs belonging to your bank or consider the reimbursement options that some banks offer. 3. Bank transfer fees. Money transfers, whether national or international, are often subject to fees. Banks may charge a fixed fee or a percentage of the amount transferred. It is advisable to research and compare fees before making large transfers. 4. Return check fees. If you try to write a check for an amount greater than your account balance, the bank may charge a fee for the return check, in addition to the transaction being rejected. Avoiding writing bad checks is essential to prevent these fees. How to avoid bank charges. 1. Check your account conditions. Make sure you know all the fees associated with your bank account. Read the terms and conditions and look for an account that has low or no fees if you don't meet certain requirements. Some banks offer fee-free accounts if you maintain a minimum balance or make a minimum number of transactions per month. 2. Choose the right bank. Comparing the fees of different banks is an effective way to avoid unnecessary commissions. Many banks offer accounts with no monthly fees, especially if they are savings accounts. There are also online banks that tend to have fewer fees than traditional banks, as they operate with lower costs. 3. Avoid withdrawals from other ATMs. As mentioned above, withdrawals from ATMs outside your bank network usually incur a fee. If possible, use ATMs from your own bank or look for those that do not charge you for withdrawals. You can also consider making a single large withdrawal instead of several small ones, which reduces the number of fees you pay. 4. Automate your payments. Some banks charge fees for manual payments or transfers. By automating your recurring payments, such as bills, loans, or services, you can avoid additional charges and ensure that you never miss a payment, which could result in late payment fees. 5. Maintain an adequate balance. Some banks charge fees for maintaining a low account balance. If possible, maintain a minimum required balance to avoid maintenance fees. Also, if you maintain a sufficiently high balance, some banks may offer you additional benefits, such as higher interest rates or exclusive services. Conclusion. Proper management of your bank accounts is essential to avoid unnecessary charges, such as overdraft and bank fees. By keeping proper control of your finances, reviewing your account terms, and adopting responsible practices, you can significantly reduce the costs associated with using banking services. Using your accounts efficiently not only helps you save money, but also contributes to better financial health. In the next chapter, Debt Management. How to get out of the vicious circle, we will explore practical and effective strategies to reduce and eliminate debt, allowing you to free yourself from financial burden and improve your long-term economic well-being. Chapter 13. Debt Management. How to get out of the vicious circle. In this chapter, we're going to explore how to manage debts effectively and how to get out of the vicious circle of indebtedness. Over-indebtedness can become a heavy burden if the right measures are not taken to address it, but with a disciplined and strategic approach, it is possible to get out of this situation and regain control of your finances. Proper debt management not only involves paying what you owe, but also establishing a plan to avoid falling back into excessive debt. What does it mean to manage debts effectively? Effective debt management involves making informed decisions to pay off debts systematically, reduce interest costs, and, ultimately, become debt-free. This not only refers to making monthly payments, but also to understanding how debts are structured, identifying the most costly ones, and applying strategies to pay off debts more efficiently. 1. Understand the structure of your debts. Before you start paying off your debts, it's important to be clear about what debts you have, what the interest rates are, and what minimum payments you need to make. Creating a detailed list of all your debts will help you prioritize them and make strategic decisions about how to pay them off. Here's how to do it. Interest rates. Identify the debts with the highest interest rates, such as credit cards. These debts tend to be the most expensive, so they should be your priority. Amounts and payment terms. Check how much you owe on each debt and your payment term. This will let you know how quickly you can eliminate each debt. Minimum payments. Make sure you are making at least the minimum payments on all your debts to avoid late payment charges or additional interest. 2. Strategies for reducing debt. There are several strategies you can use to effectively reduce your debt. Here are the most common and effective ones. Snowball method. The snowball method involves paying off the smallest debt first. Once the smallest debt is completely paid off, you take the money you are allocating to that debt and apply it to the next smallest debt. This approach gives you a sense of progress and motivation as you eliminate one debt after another. 2. Avalanche method. The avalanche method focuses on paying off debts with the highest interest rates first. Although this method may not offer the same immediate psychological rewards as the snowball method, it is more financially efficient because it minimizes the total cost of the debt by reducing the accumulated interest. 3. Debt consolidation. If you have several debts with high interest rates, one option is to consolidate them into a single loan with a lower interest rate. This allows you to simplify your payments, as you will only have to make one monthly payment, and at the same time you will reduce the amount of interest you pay in total. 4. Debt refinancing. Refinancing is another strategy that consists of obtaining a new loan with better conditions, lower interest rate, or longer terms, to pay off existing debts. This can reduce your monthly payments and help you get out of debt more quickly. Make sure the new conditions are really favorable and not just a temporary solution. 3. Avoid common mistakes that keep the debt cycle going. The problem of over-indebtedness is often perpetuated because people make certain mistakes that make it difficult to pay off their debts. Here are some of the most common mistakes and how to avoid them. 1. Paying only the minimum. If you only pay the minimum on your debts, especially credit card debts, you are unlikely to reduce the principal balance significantly. Minimum payments only cover interest and fees, which means that your debts can continue to grow. Try to pay more than the minimum whenever possible. 2. Relapsing into credit purchases. If you continue to use credit cards and accumulate new debts while you are paying off others, you'll be perpetuating the cycle of indebtedness. Avoid using credit while you are in the process of paying off existing debts, and focus on reducing your balance before considering new purchases. 3. Failing to prioritize high-interest debts. High-interest debts, such as credit cards, should be your priority. If you don't pay them off first, you'll continue to accumulate interest and your balance will grow, delaying the process of eliminating your debt. Eliminate high-interest debts as quickly as possible. 4. Don't seek help when you need it. If you feel that paying your debts is getting you down, don't hesitate to seek help. There are financial advice and debt consolidation services that can guide you and help you get out of debt. The key is not to wait too long to ask for help. 4. Change your spending habits to avoid getting into debt again in the future. Managing debt doesn't end once you've paid it off. It's essential to change your spending habits to avoid falling back into debt. Here are some recommendations. 1. Set a budget. A budget is essential for controlling your finances and avoiding overspending. Clearly define your income and expenses and make sure your expenses do not exceed your income. Dedicate part of your income to savings and investment, in addition to debt payments. 2. Emergency fund. Having an adequate emergency fund is crucial to avoid resorting to credit in unforeseen situations. This fund should cover 3 to 6 months of essential expenses so that, in case of an emergency, you can face it without getting into debt. 3. Live within your means. Live within your means and avoid the temptation to spend on unnecessary things or items you cannot afford. Learn to differentiate between needs and wants and make sure you prioritize what is really important. 4. Control impulse buying. Impulse buying can be one of the main reasons for getting into debt. Before making a purchase, think about whether it is really something you need and whether it is within your budget. If possible, wait 24 hours before making the decision to buy. Conclusion: debt management is a process that requires discipline, planning, and commitment. If you find yourself trapped in a cycle of over-indebtedness, it is crucial that you take immediate steps to reduce and eliminate your debts. Whether through debt consolidation, refinancing, or using methods such as the snowball or avalanche method, the most important thing is to take control of your financial situation and avoid falling back into the trap of indebtedness. Changing your spending habits and setting up an emergency fund are important steps towards ensuring a more secure and stable financial future. In the next chapter, Default Prevention, Keys to Staying on Top of Debts, we will explore how to avoid defaults and how to set up an effective payment system to keep your finances under control. Chapter 14, Default Prevention, Keys to Staying on Top of Debts. In this chapter, we will explore how to avoid missed payments and keep your debts under control to preserve your financial health. Missed payments not only affect your credit score, but can also lead to additional charges, higher interest rates, and legal problems in extreme cases. Throughout this chapter, we will look at how to establish an effective payment system, strategies to avoid missed payments, and how to manage debts to maintain your financial stability. What is a default? A default occurs when a debt payment is not made within the time frame established by the lender. If you do not pay on time, the lender may apply additional charges, increase the interest rate, or, in the worst case, initiate a collection or foreclosure process. A default can negatively affect your credit history and make it difficult to obtain credit in the future. Consequences of non-payment. 1. Impact on credit history. Non-payments are reported to credit agencies and can reduce your credit score. A low score can make it more difficult to obtain loans in the future, and when you do get one, you are likely to face higher interest rates. 2. Late payment fees. Most lenders apply late payment fees if you miss a payment deadline. These fees can be significant and increase the balance of the debt, making it more difficult to get out of debt. 3. Increased interest rate. Some lenders increase interest rates on debts if there are defaults or late payments. This means that not only will you have to pay more interest, but your debt will grow faster. 4. Debt collection and foreclosure. If defaults continue, the lender can turn to collection agencies or even initiate debt enforcement proceedings, such as foreclosure or legal action. This can have serious financial and legal consequences. How to avoid defaults. 1. Establish an organized payment system. The key to avoiding defaults is to have an organized and well-planned payment system. Here are some steps to do so. Automate payments. Many lenders allow you to set up automatic payments to be made on a recurring monthly basis. Setting up automatic payments is an effective way to ensure that your payments are made on time without having to worry about forgetting due dates. Use financial management apps. Personal finance mobile apps allow you to keep track of your debts and payments, send reminders, and notify you of due dates. Some apps can also sync with your bank accounts, helping you to have a clear view of your finances. Review your debts regularly. Frequently review your payment schedule and your debt balances to make sure you are aware of what you owe. A periodic review will help you detect any errors, omissions, or missed payments. 2. Make a detailed budget. Having a proper budget is crucial to ensure that you can meet your monthly payments. A well-made budget should include all your sources of income and detail your essential and non-essential expenses. Setting a percentage of your income for debts and savings will help you keep your finances balanced. 3. Prioritize debt payments. If you have multiple debts, it is important to prioritize them. Pay off those with the highest interest rates, such as credit cards, first, as they are the most expensive in the long run. Always keep up with the minimum payments on your other debts to avoid late fees. 4. Maintain an emergency fund. Having an emergency fund is essential to avoid defaulting on payments when unforeseen expenses arise, such as car repairs or medical expenses. This fund should be sufficient to cover between 3 and 6 months of essential expenses, which will provide you with flexibility and security in case of financial difficulties. Strategies for managing debt payments. 1. Reduce the amount of your monthly payments. If you are having difficulty making your payments, you can consider strategies such as refinancing or debt consolidation. These options can reduce the amount of your monthly payments and give you more time to pay, provided the conditions are favorable. 2. Negotiate with lenders. If you are having trouble making payments, contact your lenders to discuss options. Some lenders may offer you a more flexible payment plan, reduced interest rates, or a moratorium on payments for a certain period of time. The key is to communicate proactively before the debt becomes unsustainable. 3. Make extra payments when possible. If you have a little extra money, use those funds to make additional payments on your debts. This will not only reduce the outstanding balance, but will also decrease the amount of interest you have to pay in the long term. 4. Avoid taking on new debt. During the debt repayment process, it is essential to avoid taking on new debt. New debt can make the situation even worse and make it more difficult to make payments on existing debt. If you are having trouble cutting back on spending, review your financial habits and limit non-essential purchases. The importance of financial discipline. Keeping up with your debt repayments requires constant financial discipline. This means being organized with your payments, avoiding unnecessary expenses, and making financial decisions that will help you improve your situation in the long term. By taking a systematic and responsible approach, you will be able to break out of the vicious circle of debt and create a solid financial foundation for your future. Conclusion. Avoiding missed payments is crucial to protecting your financial health and your credit score. Establishing an organized payment system, making a detailed budget, and maintaining an emergency fund are fundamental steps to avoid missed payments and get out of the debt cycle. With proper planning and financial discipline, you can manage your debts effectively and stay in control of your personal finances. In the next chapter, Insurance, a fundamental element in financial protection, we will explore how insurance can protect your assets and guarantee your financial stability in the face of unforeseen events. Chapter 15. Insurance, a fundamental element in financial protection. In this chapter, we explore the importance of insurance as a key tool for protecting your personal finances and guaranteeing your economic stability in the face of unforeseen events. Insurance is a contract that offers financial protection in the event of unexpected events, such as accidents, illness, property damage, or death. Throughout this chapter, we will analyze the different types of insurance, how to choose them correctly, and how they can help you avoid serious financial risks. What is insurance? Insurance is an agreement between an insured and an insurer in which, in exchange for a periodic premium payment, the insurer agrees to provide financial compensation to the insured in the event that a specific event covered by the policy occurs. Insurance acts as a financial safety net, reducing the economic impact of certain risks. Types of insurance. There are different types of insurance, each designed to cover specific situations. The most common include 1. Life insurance. Life insurance provides financial compensation to your beneficiaries in the event of your death. This type of insurance is essential for those with financial dependents, such as children or spouses, as it ensures that your loved ones can maintain their quality of life in your absence. There are several types of life insurance, including term life insurance, which covers a specific period, and permanent life insurance, which covers the entire life of the insured. 2. Health insurance. Health insurance covers medical, hospital, and surgical expenses in the event of illness or accident. Given the high cost of medical care, especially in emergency situations, adequate health insurance is crucial to prevent medical bills from affecting your financial stability. 3. Car insurance. Car insurance covers damage to your vehicle and other vehicles, as well as injury to other people in the event of an accident. Depending on the type of policy, it can also cover theft, fire, or damage caused by natural disasters. This insurance is compulsory in many countries, but even if it is not, it is still a prudent way to protect your investment and avoid high expenses in the event of an accident. 4. Home insurance. Home insurance covers damage to your home and its contents due to incidents such as fire, theft, water damage, or natural disasters. This type of insurance is essential if you are a homeowner, as it can help you cover the costs of repairing or replacing lost property. 5. Critical illness life insurance. This insurance provides financial compensation if you are diagnosed with a serious illness, such as cancer, heart attack, or stroke. Critical illness insurance is designed to help you cover medical expenses and time off work while you recover. 6. Disability insurance. Disability insurance replaces a percentage of your income if you become unable to work due to injury or illness. This insurance is particularly important if you are the main income provider in your household, as it guarantees an income stream even if you are unable to work. 7. Travel insurance. Travel insurance covers the risks associated with travel, such as flight cancellations, lost luggage, medical expenses abroad, and other unforeseen events. If you are someone who travels frequently, this type of insurance provides you with an additional layer of security. Why is it important to have insurance? 1. Financial protection against the unexpected. Life is full of surprises, and the unexpected can often be costly. Having adequate insurance provides protection against unexpected events that could seriously affect your financial situation. Without insurance, the expenses arising from an accident, illness, or property damage could have a devastating impact on your finances. 2. Guarantees the continuity of family well-being. If you are the main income provider in your household, life or disability insurance ensures that your financial dependents, such as your partner or children, are protected in case you are unable to provide for them due to an accident or death. This gives them the assurance that their financial needs will be met. 3. Medical coverage. The cost of medical care can be prohibitively high, especially in emergency situations. Having adequate health insurance allows you to access quality medical care without having to worry about the financial impact of paying high medical bills. 4. Investment in the protection of your assets. Home and car insurance protect your most important assets. If something happens to your home or car, insurance will help cover the costs of repair or replacement. This saves you from having to bear a significant financial burden to repair or replace expensive goods. How to choose the right insurance. 1. Assess your personal needs. Before purchasing insurance, it is essential to assess your needs and those of your family. Do you have dependents? Do you travel frequently? Is it important to protect your assets and your health? These factors will influence the types of insurance you should consider. For example, if you are a parent, life and health insurance can be crucial to ensuring the well-being of your loved ones. 2. Compare insurance options. Not all insurance is the same, and conditions can vary widely between different companies. Compare different options and make sure that the insurance you choose offers adequate coverage for your needs at a reasonable price. Don't forget to read the policy conditions, as some may have exclusions or limitations. 3. Consider the insurer's reputation. When choosing an insurer, research its reputation and the quality of its customer service. Look for reviews, testimonials, and ratings from previous customers. It is important that the insurance company is reliable and willing to pay claims efficiently should a situation arise. 4. Review coverage and premiums. Make sure that the insurance coverage covers the risks that are most important to you and that the premiums, regular payments, are reasonable and sustainable. If the premiums are too high, they can affect your budget. If they are too low, they may not adequately cover the risks you face. Conclusion. Insurance is an essential tool for protecting your financial well-being and that of your family against life's unforeseen events. By choosing the right insurance for your needs and managing it responsibly, you can ensure that you have the necessary support when faced with unexpected situations. Whether it's health, life, or home insurance, each type of insurance offers a safety net that can make the difference between financial stability and economic crisis. In the next chapter, Saving and Investing, the Path to Financial Independence, we will delve deeper into the importance of saving and investing correctly in order to build a solid financial future and achieve financial independence. Chapter 16, Saving and Investing, the Path to Financial Independence. In this chapter, we will explore how saving and investing are essential to achieving financial independence and ensuring a solid economic future. While saving is crucial to cover emergencies and short-term needs, investing allows you to grow your money and achieve long-term financial goals. We will delve into the importance of both, how to implement them in your daily life, and how to make smart decisions that will help you build lasting wealth. What is saving? Saving is the process of setting aside part of your income for the future, instead of spending it all in the present. You save for emergencies, unexpected expenses, or short-term goals. Savings are typically held in savings accounts, where the money is easily accessible and has a low return, but provides security. What is investing? Investing is the act of putting your money into financial instruments, such as stocks, bonds, investment funds, real estate, or companies, with the aim of obtaining a long-term return or profit. Unlike saving, investing involves greater risk, but also a greater possibility of obtaining higher returns. Difference between saving and investing. Saving aims to provide a financial cushion for emergencies and immediate expenses. Saved money is generally found in bank accounts with a low interest rate. The risk is low, but so are the returns. Investment, on the other hand, aims to make your money grow in the long term. Investing involves taking risks, as markets can fluctuate, but in exchange for this risk, the aim is to obtain higher returns than conventional savings. Why it is important to save and invest. 1. Emergency preparedness. Saving is essential for dealing with emergencies, such as illness, urgent repairs, or job loss. Having an emergency fund allows you to face these unforeseen events without having to resort to debt. 2. Financial independence. Investing is essential if you want to achieve financial independence and live off your passive income, that is, income that comes from your investments and not from your day-to-day work. Investing wisely can generate a steady source of income over time, allowing you to live without being completely dependent on a job. 3. Preparing for the future. As we get older, it is important to save for retirement and make sure that our savings grow enough to cover our future needs. Investing allows you to build a larger retirement fund, giving you greater financial security when you reach retirement age. Strategies for effective saving. 1. Set clear savings goals. For saving to be effective, it is important to have clear and realistic goals. Are you saving for an emergency fund? For a vacation? For retirement? Having a specific goal will help motivate you to save regularly and in a disciplined way. 2. Make saving a priority. An effective way to ensure that you save enough is to pay yourself first. This means that, before spending on non-essential items, you set aside a fixed amount to save each month. Automatically transfer a percentage of your income to a savings account before making other expenses. 3. Review your expenses and make adjustments. Once you have set your savings goals, review your monthly expenses and look for areas where you can reduce unnecessary spending. Are you spending a lot on eating out? Can you cut back on entertainment or subscriptions? Adjusting these expenses will allow you to save more without affecting your quality of life. 4. Take advantage of high-interest savings accounts. Look for savings accounts that offer a higher than average interest rate. Some online savings accounts or traditional banks offer competitive rates that will allow you to grow your money without taking risks. Strategies for investing effectively. 1. Start investing as soon as possible. The key to building wealth through investing is to start as early as possible. If you start investing at a young age, compound interest will make your money grow exponentially over time. Don't wait until you have a lot of money. Even small investments can add up over time. 2. Diversify your investments. Don't put all your eggs in one basket. Diversification is key to reducing the risk in your investments. Invest in a variety of assets, such as stocks, bonds, real estate, and mutual funds. This will help you minimize the impact of market fluctuations on your investment portfolio. 3. Invest for the long term. Long-term investing aims to grow your money over years, even decades. Don't be swayed by short-term market fluctuations. Over the long term, markets tend to increase in value, so holding your investments for a long period generally offers better returns. 4. Invest in index funds or exchange-traded funds, ETFs. Index funds and ETFs are passive investment options that replicate the performance of a market index, such as the S&P 500. These funds allow for instant diversification and have relatively low fees. They are ideal for investors looking for a simple, low-cost approach. 5. Review and adjust your portfolio regularly. It is important to monitor the performance of your investments and make adjustments when necessary. As your goals and financial situation change, your investment strategy should also adapt. Review your portfolio annually or after any major event to make sure it is still aligned with your long-term goals. Benefits of long-term saving and investing. 1. Passive income generation. Smart investing can generate a steady source of passive income, meaning you can live off the returns on your investments without having to actively work for it. This gives you greater financial freedom and the ability to diversify your sources of income. 2. Growth of personal wealth. Through investment, your money has the opportunity to grow and multiply, which contributes to the construction of your personal wealth. Compound interest, which is the process of earning interest on interest, plays a crucial role in the long-term growth of your investments. 3. Security for the future. Investing properly can provide you with the financial security you need for your retirement and ensure that you will not be dependent on income from active employment in the future. Retirement funds, such as 401k plans or IRAs, are designed to help you save and invest for retirement. Conclusion. Saving and investing are two fundamental pillars for building a secure and successful financial life. While saving helps you cover emergencies and short-term needs, investing allows you to grow your money in the long term, achieving financial independence and ensuring a prosperous economic future. Start implementing these strategies today, and over time, you will notice how your wealth grows, providing you with the financial freedom you desire. In the next chapter, Long-Term Personal Finance, Planning for the Future, we will take a closer look at how to properly plan your finances for the long term, ensuring your financial stability for years to come. Chapter 17, Long-Term Personal Finance, Planning for the Future. In this chapter, we will focus on the importance of long-term financial planning as a crucial component for achieving economic stability and security in the future. While saving and investing are vital to managing your day-to-day finances, long-term planning allows you to achieve your biggest financial goals, such as retirement, buying a house, or your children's education. We will explore how to set long-term financial goals, how to prepare for retirement, and how to structure your financial plan to achieve lasting stability. Why is long-term financial planning important? Long-term financial planning is essential because it helps you to have a clear vision of your future financial goals and sets out a path to achieve them. Without a proper plan, it's easy to feel lost in the midst of day-to-day financial decisions and lose sight of what really matters. Planning helps you prepare for important life events, such as retirement, buying a home, or paying for your children's education in an organized and timely manner. 1. Setting long-term financial goals. Financial goals are essential to give direction to your financial planning. Setting clear goals allows you to focus your efforts and resources effectively. Here's how to set long-term financial goals. 1. Define your goals. The first step in long-term planning is to define what you want to achieve. Do you want to save for retirement? Are you looking to buy a house? Would you like to have an education fund for your children? Each of these objectives requires a different strategy and should be considered when creating your financial plan. 2. Establish a time horizon. Determine how long it will take you to reach each goal. For example, saving for retirement may be a 30-year goal, while buying a house may be a 5 to 10-year goal. Setting a clear time frame will help you determine how much you need to save or invest each month to reach that goal. 3. Be specific and realistic. Goals should be clear, specific, and achievable. Instead of saying, "I want to save for retirement," say, "I want to save $500,000 for my retirement at age 65. This will help you effectively measure your progress and adjust your strategy as needed. 4. Break down goals into smaller steps. It is useful to break down long-term goals into smaller, more achievable objectives. If your goal is to save for retirement, start by saving a specific amount each month. Gradually, as your income increases, you can increase the amount allocated to this objective. 2. Preparing for retirement. Retirement is one of the most important financial goals that people should plan for, as a lack of preparation can lead to financial insecurity in retirement. Here's how to prepare for retirement. 1. Establish how much you need for retirement. Before you start saving for retirement, it is important to determine how much you will need to maintain your lifestyle after you stop working. Take into account your current expenses, inflation, healthcare costs, and any other future expenses. As a general rule, it is recommended that you plan to have at least 70 to 80% of your current income during retirement. 2. Save and invest for retirement. There are a number of savings and investment accounts that are designed for retirement, such as 401k, IRA, or pension plans. Take advantage of retirement accounts that offer tax benefits, such as tax deductions or tax-free earnings, depending on the option you choose. 3. Start as early as possible. The earlier you start saving and investing for retirement, the more time your money will have to grow thanks to compound interest. If you start saving at 25, you may need to save less each month to reach your goals than if you start at 40. 4. Review and adjust your plan regularly. It is important to review your retirement plan regularly to make sure you're on track to reach your goal. If your circumstances change, such as an increase in income or a change in expenses, adjust your savings and investment plan to keep it aligned with your goals. 3. Strategies for buying a house. Buying a house is another of the most common financial goals. It is a big investment that requires careful planning. Here's how to prepare to buy your own home. 1. Save for the down payment. The down payment is one of the biggest obstacles to buying a house. It is generally recommended to save at least 20% of the house price as a down payment, although there are options with lower down payments. Saving for this payment should be a priority if you plan to buy a house in the future. 2. Mortgage pre-qualification. Before you start looking for a house, get a mortgage pre-qualification to find out how much you can afford to borrow. This will give you a clear idea of your budget and help you avoid looking for properties that are beyond your financial reach. 3. Consider other housing expenses. In addition to the down payment and mortgage loan, there are other expenses associated with buying a house, such as taxes, insurance, maintenance, and repairs. It is important to take these additional expenses into account when planning to buy a house. 4. Planning for your children's education. If you have children and want them to be able to access higher education without going into debt, financial planning for their education is an important part of long-term planning. 1. Open an education savings account. Consider opening a savings account specifically for your children's education. In some countries, there are education savings accounts that offer tax advantages, such as the 529 plan in the United States, which allows you to save for college education tax-free. 2. Save consistently. As with retirement, the earlier you start saving for education, the easier it will be to reach your goal. Start saving even if the amount is small. What's important is consistency and the time your money has to grow. 3. Research scholarship and grant options. There are many scholarships and grants available for students, and these can help you reduce the costs of a university education. Make sure you research the options available and apply for the scholarships that could be useful for your children. Conclusion. Long-term financial planning is essential to achieving your most important financial goals, such as retirement, buying a house, and educating your children. By setting clear goals, creating a savings and investment plan, and making adjustments as your circumstances change, you can ensure that your financial future is secure. The key is to start as early as possible and maintain constant discipline to achieve long-term financial stability. In the next chapter, Managing Variable Income and Expenses, we will explore how to effectively manage variable income and unexpected expenses, which is crucial to maintaining your financial stability in changing situations. Chapter 18. Managing Variable Income and Expenses. In this chapter, we will address how to effectively manage variable income and unexpected expenses, which are common challenges in many financial lives. Economic situations can change suddenly, whether due to fluctuations in employment, changes in income, or unexpected expenses. Learning to manage these ups and downs is essential to maintaining financial stability and avoiding economic stress. We will provide you with strategies to manage your finances in times of uncertainty and how to adapt to unexpected situations. What are variable income and expenses? 1. Variable income. Variable income is income that does not come in a fixed amount each month, but fluctuates. This income can come from commissions, sales, freelance work, bonuses, or even temporary work. Unlike a fixed salary, variable income can be unpredictable and requires a flexible approach to manage it properly. 2. Variable expenses. Variable expenses are those that change from month to month and are not necessarily necessary or fixed. They can include activities such as going out, non-essential purchases, entertainment, travel, or even impulse purchases. Like variable income, variable expenses can cause the budget to get out of control if not managed properly. Challenges of managing variable income and expenses. 1. Income uncertainty. Variable income can make it difficult to predict how much money you will have available each month. This creates a challenge when it comes to balancing the budget, as you don't know for sure how much you will be able to save or spend on a consistent basis. 2. Inconsistent spending. Variable expenses are unpredictable and can increase during certain months due to special occasions, vacations, or impulse purchases. This can compromise savings and debt repayment if left unchecked. Strategies for managing variable income and expenses. 1. Set a flexible budget. The key to managing variable income and expenses is to have a flexible budget that allows you to adapt to unforeseen changes. Instead of making a rigid budget, use a system that allows room for maneuver so you can adjust expenses according to the month's income. Make sure to allocate a set amount to save, even if your income is not constant. 2. Promote an emergency fund. Having an adequate emergency fund is essential for months when your income is lower than expected. This fund will provide you with financial security if you do not earn as much as you expected or if an unexpected expense arises, such as a car repair or a medical emergency. The emergency fund should cover between 3 and 6 months of essential expenses. 3. Make saving a priority. If you have variable income, it is even more important to make saving a priority. Set aside a fixed percentage of your monthly income, even if your income fluctuates, for saving. During the months when your income is higher, you can save more, but make sure you keep saving even if your income decreases. 4. Control variable expenses. Variable expenses can quickly get out of hand, especially when there is money available from higher income. To maintain effective control of these expenses, keep track of what you're spending on a monthly basis. Limit impulse purchases and set spending limits for categories such as entertainment, restaurants, and non-essential purchases. 5. Create a category for unexpected expenses. In your budget, set aside a category specifically for unexpected expenses. This can include unexpected expenses such as medical emergencies, home repairs, or unplanned trips. While this fund should not be as large as the emergency fund, it will help you handle surprises without them affecting your finances too much. 6. Adjust your lifestyle in times of low income. If your income decreases for a prolonged period, it is important to adjust your lifestyle. This may involve reducing some non-essential expenses, such as entertainment or impulse buying. Make sure your basic needs are covered, such as food, housing, and transportation, before spending in other areas. 7. Diversify your sources of income. If you depend on a single variable income, consider diversifying your sources of income. This may involve looking for side jobs, investing in assets that generate passive income, or developing an additional source of income. By having multiple sources of income, you can reduce the impact of low-income months. 8. Use financial management tools. Using financial management apps and tools can help you track your income and expenses more efficiently. Many apps allow you to set alerts for your expenses, categorize your transactions, and track your savings. This will help you stay on top of your money, even when your income is not constant. 9. Review and adjust your budget regularly. In an environment with variable income, it is essential to review your budget regularly. As your income or personal circumstances change, adjust your budget to reflect the new reality. This constant review will allow you to maintain control over your finances, even when there are unexpected changes. The importance of financial discipline. Financial discipline is crucial to effectively managing variable income and expenses. This involves making conscious decisions about saving, spending, and investing, and avoiding the temptation to live beyond your means. Although your income may fluctuate, your financial discipline will help you achieve long-term financial stability. Conclusion. Effectively managing variable income and expenses is essential to maintaining stable financial health, especially if your income is not fixed each month. With a flexible budget, an emergency fund, and a disciplined approach to saving and spending control, you can overcome the difficulties that accompany fluctuating income and avoid falling into debt. By maintaining an organized and proactive approach, you'll be able to cope with months of low income without compromising your financial stability. In the next chapter, Financial Education in the Family, we will explore how to teach your family members, especially children, about the importance of personal finance and how to create a strong financial culture within your household. Chapter 19, Financial Education in the Family. In this chapter, we will explore the importance of financial education within the family. Teaching your children and other family members about money management from an early age can have a significant impact on their financial future. Financial education is not just about learning how to save or invest, but also about understanding the value of money, how to make responsible financial decisions, and how to avoid mistakes that can jeopardize financial stability. Throughout this chapter, you will learn how to instill sound financial principles within the home. Why is family financial education important? Financial education is key to personal and family success. If your family members understand how to manage their money and make smart financial decisions, they will be better prepared to face life's economic challenges. In addition, financial education provides tools to avoid common financial mistakes, such as over-indebtedness, irresponsible spending, and a lack of savings for the future. 1. Teaching children about money. It is important to start teaching children about money from an early age. The financial habits they develop in childhood can last a lifetime, so it is crucial that they understand basic concepts such as saving, responsible spending, and the importance of making informed decisions. 1. Introduction to the value of money. Children should learn the value of money and how it is earned. As they grow older, it is useful to involve them in simple tasks such as giving them a weekly allowance, which they can manage, to teach them about money, saving, and responsibility. 2. The concept of saving. From a young age, children should understand the importance of saving. You can teach them to use a piggy bank or a savings account so they can see how their money grows over time. As they get older, you can talk to them about the importance of having an emergency fund and saving for specific goals. 3. Responsible spending. Teach them to make responsible decisions about money. This includes evaluating whether they really need something before buying it and understanding that spending more than they have can have negative consequences. Children must learn to differentiate between needs and wants. 4. The value of work and reward. Children should learn that money is earned through work. This can be taught by assigning them tasks or jobs around the house in exchange for a small payment. They will learn that in order to earn money, they must work hard and be responsible. 2. Financial education for teenagers. When children reach adolescence, it is the perfect time to delve deeper into financial education. At this age, young people are starting to make their own decisions about money and may be exposed to financial practices outside the home, such as using credit cards or managing their own money. Managing a personal budget. Teach them how to create a budget, including their income if they have part-time jobs and their expenses. Help them identify what they spend their money on, set spending limits, and make sure they save for long-term goals, such as college or a future trip. The importance of credit. Teens should understand how credit and credit cards work. Explain the concept of installment payments and the consequences of not paying on time. Make sure they understand how poor credit management can affect their credit score and their ability to obtain loans in the future. 3. The differences between saving and investing. In addition to teaching them about saving, start talking to them about investing and profitability. You can use simple examples, such as explaining how long-term savings work or how money can grow if properly invested in products such as funds or shares. This will provide them with a solid foundation for money management in adult life. 4. Saving for long-term goals. As they approach adulthood, teach them to plan for the future. Talk about the importance of saving for college, for a car, or even for buying a house. Help them understand that money should not only be saved for emergencies, but also for the realization of personal goals. 3. Teaching adults about the importance of financial literacy. Although financial education begins in childhood, it is never too late to learn. Many adults lack basic financial education, which can result in financial problems as they get older. It is important to foster a culture of continuous financial education within the family. 1. Have open conversations about money. Families should be able to talk openly about money. If adults have financial problems or do not understand certain aspects of money management, such as planning for retirement or investing, it is essential to discuss it. A lack of communication about finances can lead to poor financial habits or a lack of preparation for the future. 2. Encourage informed decision-making. Adults should be aware of how they make financial decisions. Often, impulsive decisions or a lack of knowledge about financial products, such as loans, insurance, or investments, can lead to financial problems. Make sure that each member of the family understands the pros and cons of their financial decisions and how they affect their long-term well-being. 3. Retirement education. Many adults do not start saving for retirement until later in life. It is essential to teach adults to set goals for retirement and to contribute regularly to pension funds or retirement savings accounts. If you don't start saving early, your options for a secure retirement can be severely reduced. 4. The use of financial tools. Financial education for adults should also include learning about tools and resources that can help manage personal finances, such as budgeting apps, retirement planning programs, and financial consultants. 4. The role of parents as financial role models. As a parent or guardian, you are a role model for your children in all aspects of life, including finances. Children learn more by watching than by listening, so it is essential to practice what you preach. By following good financial habits, such as saving regularly, making payments on time, and avoiding excessive debt, you'll be teaching your children how to manage their money responsibly. Conclusion. Family financial education is the foundation for building a healthy and stable financial life. From teaching children to save and spend responsibly to helping teenagers understand credit and investing, each stage of life has key lessons that can make a difference to your family's financial future. Fostering a culture of continuous financial education not only prepares future generations for effective money management, but also strengthens family unity and long-term economic stability. In the next chapter, The Key to Personal Financial Stability, we will explore best practices for achieving financial stability throughout life, maintaining control over finances, and creating a future free of financial stress. Chapter 20. The Key to Personal Financial Stability. In this final chapter, we will explore the key principles that will enable you to achieve and maintain long-term personal financial stability. Financial stability is not just about having enough money to cover your immediate needs, but about building a solid foundation that allows you to face financial challenges, achieve your goals, and live with security. Here we will address how to make smart decisions, maintain financial discipline, and establish a growth mindset that will allow you to secure a prosperous future free of financial worries. What is personal financial stability? Personal financial stability refers to the ability to maintain an adequate financial balance that allows you to cover your basic needs, manage your debts, save for the future, and deal with unforeseen situations without jeopardizing your financial well-being. It is the foundation on which a healthy financial life is built, and it is an achievable goal through proper planning and responsible money management. Key principles for achieving financial stability. 1. Establish a balanced budget. The first step to achieving financial stability is to create and follow a balanced budget. A well-structured budget will help you control your income and expenses, ensuring that you live within your means. By setting clear limits on your spending, you'll know how much you can save each month and how much money you can set aside to pay off debts and other financial commitments. Divide your income into categories. Separate your expenses into essential, such as housing, food, transportation, and non-essential, entertainment, impulse purchases, etc., categories. Make sure you prioritize needs before spending on wants. Save before you spend. Make saving a priority. Set aside part of your income every month before making any purchases. This will help you accumulate funds for emergencies and achieve your financial goals. Review and adjust your budget regularly. As your income or expenses change, it is important to review and adjust your budget to maintain a proper balance. 2. Savings as a priority. Saving is essential to achieve economic stability. A savings fund gives you financial security and prepares you to face the unexpected, such as illness, accident, or a temporary loss of income. In addition, saving allows you to plan for your long-term goals, such as retirement or buying a home. Create an emergency fund. An adequate emergency fund should cover between 3 and 6 months of your essential expenses. This fund will protect you from financial surprises, preventing you from having to resort to debt in times of need. Save for specific goals. If you have long-term goals, such as retirement or buying a house, open separate savings or investment accounts for these objectives and contribute to them regularly. 3. Avoid over-indebtedness. Over-indebtedness is one of the biggest risks to economic stability. Living beyond your means and relying on credit to cover your expenses can lead to a spiral of debt that is difficult to manage. To maintain financial stability, it is crucial to avoid over-indebtedness and to ensure that you are not making financial decisions that jeopardize your long-term well-being. Keep your debts under control, limit the amount of debt you take on, and make sure you can pay your loans back on time. If you have existing debts, focus on paying them off as quickly as possible, starting with the debts with the highest interest rates. Use credit responsibly. If you have credit cards, use them wisely and pay the balance in full each month to avoid interest charges. Don't get carried away with easy credit and make sure that any loan you take out has a clear purpose and that you can comfortably repay it. 4. Smart investments for the future. Investments are key to building long-term wealth. While saving provides you with immediate security, investments allow your money to grow and multiply over time. Investing strategically helps you achieve bigger financial goals, such as retirement or buying a house. Diversify your investments. Diversification is essential to reduce risk. Invest in different types of assets, such as stocks, bonds, real estate, or investment funds, to protect your portfolio from market fluctuations. Start investing early. The earlier you start investing, the more time your money will have to grow. Take advantage of the power of compound interest to grow your savings. Make long-term investments. Long-term investing is key to building wealth. Instead of trying to make a quick buck, look for investments that will provide steady returns over the years. 5. Planning for retirement. Retirement is a long-term financial goal that requires advanced planning. The earlier you start saving for retirement, the easier it will be to achieve your goals and ensure a peaceful retirement. To achieve long-term financial stability, it is essential to allocate part of your income to retirement funds. Contribute to a pension plan or retirement account. If your employer offers a pension plan, such as a 401k, take advantage of the contributions made by the company and save for retirement. If you don't have access to an employer-sponsored plan, open an individual retirement account, IRA. Save a percentage of your income. Set aside a fixed amount of your income to save and invest for retirement. This percentage should increase over time, especially as you approach retirement. The importance of a growth mindset. A growth mindset is fundamental to achieving financial stability. Adopting a positive mindset towards money, saving, and investing will help you make informed decisions and stay focused on your long-term goals. People with a growth mindset see financial difficulties as opportunities to learn and improve their financial situation. Conclusion: personal financial stability is not a goal that is achieved overnight, but a continuous process that requires discipline, planning, and patience. By following the principles of a balanced budget, saving and investing responsibly, avoiding excessive debt, and planning for the future, you can achieve the financial security you desire. The key is to make smart decisions today to ensure that your financial future is protected. Maintain a positive and disciplined mindset, and you will be on the path to a stable and successful financial life. With this last chapter, we conclude our journey through the best practices for achieving and maintaining personal financial stability. Remember that continuous education and focus on your goals are essential to achieve financial independence. We invite you to continue learning and applying these principles in your daily life to guarantee a solid financial future. If you like this content, don't forget to subscribe to Audio Mentors, your space to continue learning about personal finance and other topics of interest. Thank you for joining us on this journey.